but we're going to wrap.
Money in the bank.
Rates are good. Pretty exciting.
You know why? Why?
Free money. You understand what I'm saying?
Welcome back to the program. I'm all excited about the mortgage segment this
Are you?
I'm all excited because
Most people are.
they raised the conforming rate or level, and that is so important to who?
Nobody.
I know.
Nobody. But every loan officer in the Twin Cities has now posted on social media. Great news. We're taking applications. You're not. You're barely making your house payment right now.
Yeah.
So stop it. But if you're interested, what are the new conforming loan limits? $766,550.
And what's that mean to anybody?
Just means that conforming means Freddie, Fannie buy it versus it have to be non-conforming or another bank with a jumbo product. So
what's that mean to the consumer?
Rates are better.
Are they really better?
Yep. Oh, absolutely.
So with rates, I'm seeing some people like, we got 6.25%. Is that a thing, or where are rates right now?
Rates right now, that is a thing. If depending on what you're doing, you're either buying it down or doing a buy down. But rates, we had a nice week this last week. I wrote down orderly and moderate. That's what the bond market has done. It was orderly and moderate this past week, bringing rates back into line a little bit. So we're probably mid-sevens, low sevens right now.
Okay.
If you're doing like a 2-1 or 1-0 buy down, you're probably low sixes.
Okay.
Now we're doing 2-1 buy downs. We're getting down you get down in 5.5.
There's been some, I think, mixed messaging coming out of the overall economy conversation, and that is that we're going to start. We're not going to do any more interest rate hikes.
Correct.
From a Fed standpoint. Yep. And then, moving forward, more than likely, we're going to start doing some cuts in 2024, and interest rates will probably be down into the sixes by the end of 2024 and maybe into the high fives or mid fives by the end of 2025.
I think that's
So this is what I've heard,
picture.
right? Mm-hmm. But then now the other day, it's like, the Fed's probably going to now increase interest rates in the fourth quarter yet here this year, 0.25%.
Mm-hmm.
So they're going to hike their interest rate
one
more time.
I did not hear that.
And now then they'll sharply, the word is sharply reduce rates next year, which kind of throws the markets into a little bit of a tizzy.
Yeah, for sure.
Right?
Yep.
So what do you think about all that? Have you heard the same thing as I have?
Yeah, the same thing. Now they are saying in December this year yet they'll do one more rate increase potentially because
I did not hear that. What am I doing?
The economy is not slowing, regardless of what they're trying to do. It's not slowing. It is truly slowing if you peel back what really matters to people. Mm-hmm. It's devastating.
Right.
But not by the measurement standard they use.
I don't even going to ask the question.
So
but use the correct metrics.
Yep.
Right.
Yeah. Maybe they'll listen to the show, change everything.
Oh, I'm sure they're listening.
So one potential increase yet this year, starting in June of next year, they say they're going to do 4 cuts up for a point a quarter each.
Starting in June.
In June,
okay.
Yeah. Well, you're coming. This is so transparent. Coming into the election, we're going to lower rates.
Right. Yeah. So because June, July, August, September, right into the fall here now.
Right.
Heavy political season.
I mean, this is so. It's like, oh my gosh, please! I hope everybody sees this.
But the general public is so gullible that they
shocking.
It happens every election cycle.
Yep. So, but in terms of how does that impact rates? We're seeing a night like we're happy if we can get down even like low sevens. So now you're doing maybe you're doing a 1% origination fee. You're getting 6.99. Just having a 6 in front of it, boy, that changes the conversation for people. And you're not talking about 8 anymore. So now even some of the bad credit stuff, you're getting into the 7s. And so, I mean, we're really happy. We've seen a little tick up in activity.
There has been a tick up in activity reported just in purchase loan applications.
Yeah, it says purchase applications increase as rates hit 10-week lows, right?
So
we're seeing a little bump up.
Do you think that this 0.25% quarter point increase from the Fed in December, which is likely to happen, will impact mortgage interest rates?
They'll pop up a little bit, but I don't think dramatically.
Don't you think that that's already kind of baked into where we're at?
Well, initially they were saying we're not going to do it, and then rates have
sure kind of
now they kind of are saying, hey, we're going to do one more.
Okay, so
I think it's coming back. I think it'll come back, but I hope that we're done saying the word 8. right?
Yeah, that would be
that would be
helpful.
great. You know, if we just say, hey, we're in the sevens, high sixes, sevens, you know, low sevens.
Even if you're still trying to sell a loan at 7%, it's challenging because especially if we're looking at our move-up buyer that we were talking about, where they have a 3.5% interest rate, their rate now is double.
Oh, for sure.
You know, their payment on the same house would double. That's a hard pill to swallow.
Yep, it is, but it's better than. We're just happy.
Yeah.
You know, just let me be happy, Keith, because rates are. If I can say 6.99, we get you in the sixes, and then we do a 1-0 buy down. We're high fives or we're high fours with a 2-1 buy down. I mean, let me live there. I can get people there, and then we can comfortably say, okay, we got time. Let's do some things. So
yeah, you got to step up over the next couple of years to your payment.
Yep.
Do you think
Comfortable with the highest one.
Yep.
But
will you think
enjoy the
for it.
lower? Yep. Enjoy the lower for a period of time.
Yep.
Do you think you're going to have more people putting, striving towards that 20% down to get rid of the mortgage insurance premium to try to help get their payment down, or do you think that people are just going to, what's the sweet spot there?
I think the sweet spot is using buy downs, to be honest with you.
Okay.
But
that's temporary.
Yep. But so are the rates. The rates aren't going to be here forever. So if you can get some relief for the next couple of years, at least buy yourself time, I think you're fine. We're not seeing more people don't have money, right? So we're not seeing more people putting 20% down. We're seeing less people do that. Plus the rates are better under 20% than they are at 20% because the mortgage insurance gives protection to the lender. So now we're seeing,
so that protection is removed and the interest rate pops up. So it's one way or the other.
And on top of that, because they remove these loan level price adjustments, which no one cares what it means, but what they did is they said, hey, we have to make things more attractive for first-time home buyers who typically have lower credit. So now I was pricing out a deal and it was kind of banged up credit, not horrible, but just like, I'm like, and prior to that, great credit. I'm pricing out the almost virtually the exact same loan. Guess who had the better rate? Lower credit
person.
I'm like, how the heck is this? And then I'm like, there it is. No loan level price adjustment.
Because
they're just trying to incent Freddie and Fannie remove.
Was that a first time home buyer or what?
Yeah,
it's not incent. It's subsidized.
Yeah.
Yeah.
So. Anyway, so if you have banged up credit, it doesn't hurt you as much as it used to. Now, but it's still a little different. But
so the bank is still going to get their interest. They're just getting it from the higher qualified individual than the lower qualified.
There's numerous articles that were out
subsidy,
saying,
right
like,
there.
hey, good job with that great credit because we're going to need that one to help offset this one.
Right.
Well, you become an insurance company now. You take the premium in Nebraska. Well,
right.
I guess it wouldn't be Nebraska, would it? Because that's a high tax.
That's the high one.
That's
in Hawaii.
Okay,
right?
you take the premium from Hawaii
and
to pay for
your
the losses
Arkansas.
in Nebraska.
Yeah. So that so we're seeing some of that. We have a really cool just because this segment goes the fastest of the show.
I know it's the best one ever.
It always is so good. An interesting bridge loan that came out. So let me tell you a little bit about that. So let's say you want to buy your new home, but you still have to sell yours, right? So. But we have this payment, now we have this payment, we don't qualify. So how do we get around this? Well, we have a loan product now that we do a bridge loan on your existing home. So we do a cash out refinance here, right? And we pay off your first.
A HELOC or is it a refi?
We're paying off your first mortgage and giving you the cash out you need.
Okay.
Up to 75% loan to value.
Okay.
Okay. No payment on that for 6 months. Wow. Now
huge.
It's incredible. Now we take that money, we go buy our new home because we have the cash. We secure our new home, and then this home goes on the market.
Is that
we
accumulating
sell it.
interest then during that time?
Yeah, it is. Yep.
Okay.
But only 75% LTV.
Yep, 75L. So it's for the
and
right.
The interest rate is what? Just curious.
8. A little over 8. So hopefully
so
that comes down.
So you pay to play, but it
pay to
puts
play.
It together.
Yep. But how many people did we miss out on because I want to find my new home
sure.
first.
Where were you on this 6 years ago?
I feel like that's not a fair question. I was right here saying you can't do that.
Always just reacting to the market
Yep.
instead of preparing
I know
in
it.
advance.
Well,
Hey.
we've got the arrow in the quiver now for the next time the market
Yep.
turns.
No, it'll go away by then because it'll be
Yeah, we're
scared
gonna
to-
take it
Yeah.
away then.
Yeah.
Float it.
No, but kind of a cool program, right?
That's cool.
I mean, that is kind of cool. No payment on that. I'm like, wow, that's
I have
interesting.
somebody in mind for that actually. So.
Yeah.
All right, well, call me. Where are rates? Just to reiterate again, rates are kind of low sevens, mid sevens, and then there's a lot of things we can do once we have the conversation with you on like, okay, what's your situation? What are you trying to accomplish? Big picture. How long are you going to be in the home? All that. That's all that conversation we need to have, and then we can direct you down the right path. So, love to have a conversation with you. Call me at 651-231-2500. Again, 651-231-2500. Love to have a conversation.
All your home mortgage and refinance needs. Refinances will be back for sure for those folks that are purchasing homes now and in the near future. You'll have an opportunity to adjust your interest rates in the future. So always call Calvin at 651-231-2500. This is, of course, Real Estate Chalk Talk. I'm Keith Hittner for Keith Hittner and Kelvin Kaemingk, and we're going to head out for this week. Give us a call, 612-627-8000 to continue the conversation, 612-627-8000, and we'll see you next week.
You've been listening to your Real Estate Chalk Talk with